Lesson 2.1 from your textbook. This lesson addresses using T accounts in accounting transactions. As we've learned in class, we have an accounting equation that everything in accounting is based off of. Assets must equal liabilities plus owner's equity. Similarly, T accounts have a left side and a right side, just as the accounting equation. The debit side is always the left and the credit side is always the right. Assets have normal debit balances. Asset accounts include cash, supplies, accounts receivable, and prepaid insurance, while liabilities have a normal credit balance. Those are accounts payable accounts. Capital has normal credit balance. The normal balance side is always the increase side of an account. Assets are things we own, liabilities things we owe, and capital is what our business is worth overall. Let's do a little review. Test your knowledge. Select true or false. An amount recorded on the left side of a T account is called a credit. False. It would be a debit. An accounting device used to analyze transactions is called a T account. True. Assets are on the right side of the accounting equation. Remember, assets equal liabilities plus owner's equity. The answer is false. The side of the account that is increased is called the debit balance. False. It is the normal balance side. The owner's capital account is on the right side of the accounting equation. True. Lesson 2.2. Analyzing how transactions affect accounts. Remember, the equation must always be in balance. If it isn't, something is wrong. August 1st received cash from owner as investment $5,000. Cash is affected and Kim Park Capital is affected. Cash is an asset, Kim Park Capital is owner's equity. Assets are increased, as is owner's equity. $5,000 is debited in cash and credited in Kim Park Capital. Notice that our equation is still in balance. August 3rd paid cash for supplies, $275. Supplies is affected and cash is affected. Both are assets, both on the left side of the equation. One goes up, one goes down, and our equation is still in balance. In this case, assets stay the same. Since no changes have been made to liabilities or owner's equity, our equation is still in balance. August 4th paid cash for insurance, $1,200. Prepaid insurance and cash are the accounts that are affected in this transaction. Both are assets. Again, one going up, one going down, but assets overall staying the same. $1,200 is debited to prepaid insurance and $1,200 is credited to cash. August 7th, bought supplies on account from Supply Depot, $500. Supplies is affected and accounts payable Supply Depot is affected. Supplies is an asset, accounts payable Supply Depot is a liability. It's something we owe. Assets are increased, as are liabilities. $500 is debited to the account supplies and credited to the accounts payable Supply Depot, thus increasing both. August 11th paid cash on account to Supply Depot, $300. Cash is affected, accounts payable Supply Depot is affected. Assets decrease and liabilities decrease. In this case, $300 is credited to cash and $300 is debited to accounts payable supply depot. This transaction affects the accounting equation by causing both the left side and the right side to decrease. Lesson 2.3. This is the last section of the chapter. Analyzing how transactions affect owner's equity accounts. August 12th received cash from sales, $295. Cash and sales are affected. Assets are increased, owner's equity is increased. Cash is debited by $295 and sales, which has a normal credit balance, is credited $295. August 12th sold services on account to Oakdale School, $350. Accounts receivable Oakdale School is affected, as is sales. Accounts receivable is an asset. Sales is part of owner's equity and has a normal credit balance. Accounts receivable is increased, as is sales. In this case, $350 is debited to accounts receivable Oakdale School and $350 credited to sales. Paid cash for rent, $300 on August 12th. Cash is affected, and another kind of owner's equity account, an expense, rent expense, is affected. Cash goes down, rent expense goes up, which causes capital, owner's equity, overall to go down. Cash is credited $300 and rent expense is debited $300. When a subsidiary account, such as an expense, takes away from the overall balance of a larger account, capital, that's considered a contra account. August 18th received cash on account from Oakdale School, $200. Cash is affected, as is accounts receivable Oakdale School. Both are assets. Cash is debited $200. Accounts receivable Oakdale School is credited $200. August 12th paid cash to owner for personal use, $125. Cash is affected, and another owner's equity account, Kim Park Drawing, is affected. Drawing goes up, cash goes down. Since drawing is a contra account of owner's equity, when drawing goes up, the overall balance of capital goes down. This allows our accounting equation to remain in balance. Let's take a moment to review again. Increases in the owner's capital account are shown as credits. When services are sold on account, accounts receivable is debited. When cash is paid for an expense, the expense account increases. Cash received on account is a debit to cash. A revenue account has a normal credit balance. Remember, revenue is sales. Great job. That concludes today's lesson. Tune in next time for more lessons in basic accounting. And remember, make sure you complete all your Chapter 2 assignments.